So good morning, everyone. It's certainly been a challenging conference from a supervisor's perspective. We've heard a lot about what we're not doing and why we lag the world. Sometimes that's a good thing. It's good to have somebody take away the punch bowl before the party gets too crazy, using a monetary affairs euphemism. But I'm pleased here today to moderate a panel with Brandon Milhorn, who's currently the president and CEO of the Conference of State Bank Supervisors. He leads the CSBS in advancing the dual banking system and supporting state regulators by providing technology, training, and a forum for developing multi-state policy. And the CSBS has been a great partner to federal regulators, and I think in many ways federal regulators have been a good partner with the CSBS. But as you'll see in the discussion today, we have different scopes and different motivations and different missions, and those come to fore here. He also spent a number of years at the FDIC under Vice Chair Travis Williams and former Chairman Jelena McWilliams, and spent years at Raytheon in a cybersecurity, technology, homeland security advisory capacity. So I'm looking forward to the conversation. But let's start, Brandon. First of all, as you know, and based on the conference, we have been very focused on this issue of innovation, as the regulators like to say, responsible innovation, as the industry says, glacially slow innovation, but it is here, and it is critical, and it is critical to banking organizations and community banks, particularly the CSBS has a vested interest in there. And I think we have seen regulators in the near term try to get more information about what they're expecting with fintech and bank partnerships. And also that's come through guidance on third-party relationships. It's come through, quite frankly, some formal written enforcement actions, which I think people should take the time to read. But what are your thoughts on how we should be doing more to foster the coordination in a reasonable way that supervisors are concerned with?
Thanks, Bill. And President Harker, thank you. Jalapa, thank you so much for having the Conference of State Bank Supervisors here. We've been around since 1902, so we've been through the innovation cycle or two over the course of our history. And obviously, we have our roots in banking and state charters and community banking, but the states, and this may be news to our friends in Washington, we also have supervision authority with respect to non-banks, including mortgage servicers and money transmitters and other financial providers for consumers. And so we sit sort of at the cusp of the interaction between our banks and our non-banks. And I have to say, our members are, I think, quite concerned about where we're going with regulatory policy related to our community banks. And that's separate and apart from the innovation question that you just asked. We've lost about over 12,000, nearly 13,000 community banks over the last 11 years. And that should be a concern for us all, because these community banks, our system is just set up differently from any other system in the world. Our local communities, our local businesses, the small businesses depend on community banks. And with the increasing cost associated with technology, increased regulatory and compliance cost, increased personnel cost, all that layer of cost is weighing on community banks and their ability to serve their communities. And so if we don't think about ways that they can grow their business, that they can expand their operations to scale to address those costs, they're going to go away, and they have been going away. And so it's a great concern for our members. And innovation provides an opportunity for those banks to survive, whether it's adopting technologies on their own or partnering with third parties. And when I got to the FDIC, I was a national security lawyer before I got to the FDIC with Chairman McWilliams. You could see the importance of innovation to the survival of our community banks. We were very focused on that and very focused on how we can foster innovation. I'm concerned that over the last few years, we haven't seen, despite all the guidance, despite all the enforcement actions, we've not given any clear guidance, any clear expectations to banks on how to do this effectively. And that should be a concern from a supervisory standpoint, from a consumer protection standpoint. We've seen, dramatic issues like the Synapse collapse. We've seen the enforcement actions pile up. And my concern, Bill, is that more banks are getting out of the innovation business that are coming in. And that should be a concern for all of us, certainly the consumers that depend on them.
So let's talk a bit about that, because as you said, there have been attempts to get information out to try and understand the risk management. I myself, when I'm out talking to my bankers, say, please come and talk to us before you start something so we can have an informed conversation. I also think you've mentioned that, in the states, this is kind of a breeding ground for this. States are in different places, and the public-private partnership. So in this way, what advice do you think we'd give to regulators or to community banks about how to engage with us more on this conversation around what's expected before sometimes they get in a little over their head?
That's a great question. The consistent guidance that I hear from supervisors is come talk to us. If you're thinking about a new business model, if you're thinking about adopting new technologies, go talk to your state supervisor. Go talk to your federal regulator. Have a conversation with them about what you're getting into and the expectations. I think one of the other challenges that we see is when a bank reaches, sort of their mouth's too big for their stomach, right? If you just try to bolt on these capabilities, you're going to be really challenged. It's got to be part of your business model. If you ask yourself, am I really committed to this as a business line, as a business model? Because the costs are real. It is challenging from a BSA AML's perspective to take on new transaction models. It is challenging to make sure that your partner institution that may be doing lending is meeting all the fair lending and consumer compliance requirements, and ultimately you're on the hook for that as a financial institution. So yes, start off, talk with your supervisors, have a conversation, talk with your board, make sure this is core to your business model. That's sort of table stakes. My concern with the framework that we've created in the United States around this is that I feel like sometimes our regulators try to keep industry at arm's length. And we give guidance, but it's designed to let business make its own mistakes. I think we need to get our hands a little dirty on this as regulators, get in the engine and start working with industry on how to make this better. Public-private partnerships are a great example. I've seen it in Homeland Security. Port Security started with a public-private partnership model, and it was incredibly effective. There are standard-setting organizations that have encouraged industry to adopt new ideas and new solutions without regulator overlap. So those are, I think, great ideas that we should be exploring, Bill.
So let's explore that a little bit more, because I've often said the states and state supervisors have a much broader scope than I do as a federal supervisor, right? I'm primarily interested in bank holding companies and state member banks. That's a very narrow focus in terms of financial services today, particularly given the states have mortgage servicers, money transmitters. In some cases, they have pawn shops, other credit and finance facilities, which are serving, a wide range of community, and in many cases are serving, as we've talked about here, an unbanked community for more traditional finances. That being said, I have to encourage the banks to talk. Do you think at the state level or at the federal, there needs to be more discussion about a comprehensive view, and particularly more discussions with the fintech firms themselves around our expectations?
Yeah, I think absolutely that's important. Engagement with the industry helps regulators understand real-world challenges. You can't sit behind a desk in Washington or in any state capital and not expect to engage. And I think that's where our state supervisors really have a different perspective on oversight than our federal counterparts. We start with safety and soundness. We start with consumer protection, just like our federal partners. But our state supervisors also have responsibilities for economic development. So those local banks are also local businesses. They support a broader economic footprint in each of the individual states, and that perspective sort of informs how they approach supervision. As you get farther and farther away from that local perspective, the willingness to sort of trend toward maybe overcorrection on innovation, I think is real. One of the questions I think we have to ask ourselves is the prescription, what we're prescribing to the patient for innovation, going to kill the patient, right? And that is a concern I think all of us have to deal with as regulators.
So let's talk a bit. You talked about your past experience with private and public infrastructures and setting standards. Are there private enterprises you see? We certainly have a wide range of them here, but are we beginning to see the emergence in the fintech space and the innovation of kind of independent standard setting organizations that we should all be trying to leverage or at least communicate with?
Yeah, of course, standard setting organizations have been around for hundreds and hundreds of years. Look at the top of your light bulb when you screw it in. Underwriters Labs, that's a standard setting organization. It's made our houses more secure, our use of electricity more positive. Their Energy Star, when you go to buy a refrigerator, that's a standard setting organization driven from a public-private partnership. It's a great opportunity. I feel like often from a public sector perspective, it's challenging for us to keep up with the pace of technology. We can't write regulations fast enough to keep pace with technology. Standard setting organizations are not speedy by any means, but they're going to move faster than regulators always. And working with the private sector, regulators work regularly with the private sector. We work on with our counterparts in Europe on standard setting relative to innovation. Regulators participate in things like FDX and X9. Those are standing setting organizations that currently exist in the financial space. Think of SOC, right? Our cybersecurity standards. Those are driven by private sector partnerships. I think it's an opportunity that we should explore in this space. Because the question is, I always think about innovation and adoption as sort of a speed bump from a bank standpoint. You've got technology costs, you've got regulatory costs, you've got operational issues and integration costs. And as regulators, my question, the question sort of I always ask myself is, how can we reduce those costs, encourage banks to drive over that speed bump while still preserving safety and soundness and consumer protection? And I think standard setting is a way not only to give banks confidence in the tools that they're bringing in to their system. They've got that good housekeeping seal of approval that they can rely on, but it also gives fintechs a standard to target. They're not coding to a moving target anymore. They're coding to a standard, and then step back even further and think of the confidence that it might provide to regulators in this space. Visibility into a system that is a challenge for us. Setting aside the argument about jurisdiction, whether the Bank Service Company Act gives us authority to go in and supervise at the federal level. States also have that authority. I think the authority to supervise fintechs is actually pretty clear. But stepping back from that, from a resource standpoint, from an examiner standpoint, the amount of institutions that are out there are just going to overwhelm our supervisory process. We can't go in and supervise everything. But if we have visibility into a system from a voluntary standard setting organization where fintechs voluntarily come forward, get certified, it gives confidence to the banks, it gives confidence to consumers, and it gives additional visibility to regulators that they may not have had and may never get if we don't. So to me, if we don't start exploring solutions just like this, we're tying our own hands. And when we can't move as fast as industry, we become an anchor on innovation as regulators. And that should be a concern for all of us.
So let me switch the topics and we go with your national security background a bit. And I'll knock on wood here because I don't want to jinx myself. I actually think community banks and banks in general are doing a better than I would have expected world in guarding against cyber, in guarding against hacking attacks. Doesn't mean they don't happen, but they seem to be prepared and they seem to be responsive. From your perspective, what more should we be doing, particularly for community banks, to ensure they don't run into significant cyber problems or hacks?
Yeah, cybersecurity is going to be an ongoing challenge. Whether it was on Homeland Security or in Intel, when I moved over to the banking space, this threat is going to continue to evolve. It's real. It challenges us every day. It's relentless in many ways. I appreciate the work that the private sector's done. I think we've taken these concerns from sort of the back rooms of IT departments now to the boardroom. The boards understand the importance of cybersecurity. And I feel like it's that with that sense of urgency that we have to be able to tackle all these challenges. And we've done a lot of great work with the Secret Service to provide guidance. We put out, CSBS put out a RSAT, the tool for both banks and non-banks, sort of a checklist on how firms can prepare for ransomware attacks. But it's just good oral hygiene from a cyber perspective regardless. So if you haven't looked at the RSAT, go to our website, csbs.org, find the RSAT tool and look at it for your institutions, because particularly since the CAT has been moved away from at the federal level, providing some additional guidance for institutions on cyber is going to be important. More broadly from my national security background, I think of from an urgency standpoint, how we address challenges. I often say, like, when regulators talk about technology, I feel like sometimes it's like they're standing on the very cusp of the ocean. The waves are hitting their feet, and they're trying to hold back the tide. Well, the tide is coming in, and we've got to figure out a way to address the challenges associated with that. As regulators, you just can't say no all the time, and I think that's a cultural issue, sort of a mindset issue for us. You can't take that approach in national security. The threat is going to evolve. The technology, the challenges are going to evolve. You have to think offense and defense at the same time. And I want to bring that perspective over to the sort of the financial regulator side and think about how are we protecting this ecosystem? How are we protecting consumers? How are we encouraging a dynamic and innovative financial services system in the United States? We can get there, but it takes a different mindset, I think, from regulators.
So we had spoken earlier, and I'm going to just kind of give you an opportunity to say it. So fairly new to the CSBS and state supervision, and financial supervision is a different world, as you said, from many others. But in terms of where you really want the CSBS and the Federal Reserve and the federal regulation, I mean, what do you think are the imperatives for you over the next year and a half in terms of moving federal state supervision forward, either in fintech or other critical areas?
That's a really good question. I think we have to think carefully about how we talk about problems in this space. I've seen a lot of discussions over the last little bit about a federal payments charter, or what the federal government needs to do on payments. And before we get into a wholesale revision of a system that's working well for consumers right now, driven by the licensing, supervision, and consumer protection that states already provide in this space, by the work that the states have done with respect to the money transition model law. Like 99.7% of consumer funds right now are covered and protected by supervision occurring at the state level with respect to money transmission. I think we forget that. Are there innovations? Are there challenges that we need to make targeted decisions about? What's the impact of wallets? What's the challenges associated with a bankruptcy? How do we effectively coordinate bank partnerships to allow non-banks to get access to the payment rails? Maybe there's a broader discussion to be had about getting other access to the rails. States are leading right now as it relates to some charter mechanisms to give entities that aren't banks, aren't traditional banks, access to the payment rails. So before we go out and blow up the entire system and just add another federal regulator, for what? I think the question is, let's start having good, understood discussions that are targeted at the real risk in the system. So to me, that's if we can help address some of the myths in this space and start talking about the real challenges affecting innovation in the sector, to me that would be a win for CSBS in 2025.
So one last question here, and this will be on kind of the cutting edge of technology. Let's talk a bit about stable coins. So I'm a bit of a historian, and I think stable coins may have a place. I also recall that historically, before the Civil War, there was a lot of currency across the U.S., and that led to a lot of problems because not all that currency was reasonably backed. And I think the states are in many ways an incubator of these types of technologies. Thoughts on stable coins or how they might fit into the financial landscape for banks going forward?
Yeah, we have, at CSBS, we've supported a federal framework for stable coins. We've supported a legislative path ahead on this, as long as states reserve their rights with respect to chartering institutions. States, again, are leading the way with respect to stablecoins, whether it's New York, Nebraska, California. There are several states that have moved forward with sort of licensing regimes to allow this innovation to occur. I think what we need to insist on here is transparency with respect to capital structures. I think that's important. Making sure that from a cyber standpoint, from a just sort of the nuts and bolts of finance, that stablecoin providers are making these decisions smartly and implementing systems effectively. That, to me, is the opportunities we have here. I think a federal framework with a state path to licensure would be well received by industry.
Well, thank you for this. I want to say also just thanks to you and the CSBS through my career, which spans about 30 years now, I'm sorry to say. The CSBS and the states have been great federal partners with the Federal Reserve, whether it's with community banking conferences, whether it's ideas like this. But I hope those dialogues continue because I think the states have proven to be a good incubator of innovation. And so hopefully we'll come to some of these standards you're looking for.
Thank you, Bill. That partnership is so critical. We appreciate it.
Thank you.